This is Quint Bilo with a brief illustration of Chapter 3, Adjusting Journal Entries. There is additional coverage of this topic in a longer presentation. As indicated, adjusting journal entries are part of the second stage of the accounting cycle. The first stage is to get information into the ledger. The second stage is to prepare financial reports. What's the purpose of adjusting journal entries? To update financial condition for certain events that are not accounted for on a daily basis. Now, it's necessary to refresh both financial statements. We're talking balance sheet and income statement. The income statement, of course, is a key change to the equity position. Has a profit been made? If so, it increases the owner's equity category. Adjusting entries are essential before financial statements are prepared. If not, inaccurate statements result. The textbook has two types of adjusting journal entries: accruals and prepaids. Accruals involve journal entries before any payment of cash has occurred, payment or receipt of cash. Businesses can make a credit sale, which is creating a promise account receivable. The offset would be a revenue account, the income statement. Or that same business can receive a service benefit. It must create a liability, offset, expense account in the income statement. Both these conditions are called accruals. They anticipate cash flowing later. The second type of adjusting entry is prepaids. This is adjusting a previous entry that involved a flow of cash, either in or out. Either businesses may receive cash in advance, creating an unearned liability. They must adjust that later at period end, how much of that has been earned, shifting into a regular revenue account. Or businesses may have purchased an asset in advance, like insurance, and as benefits are used up, it has to adjust that asset downward, and the offset is an expense account. These are both conditions are called prepaids, and as mentioned, the offset to both of the liability and asset accounts are an item in the income statement. So the process of recording accruals or adjusting prepaids is the work of adjusting entries. Let's demonstrate an accrual adjustment, the first type. An example of a business receiving a service benefit and paying for it later. The adjustment goal is to record an expense with a debit and record a liability with a credit. Recording an expense before it's paid. We'll use electricity as an example, getting billed at month end for usage and having to pay for that later the next month. So let's take an electric utility that takes a meter reading in October. It measures $800 of electricity usage for the month. It sends us a bill, asks for payment on November 15th. First, did we receive a benefit during October? We sure have, but no payment is needed until November. So when do we record the entry? So at month end, before an adjusting entry, we have no record of this transaction in our accounts. After we receive the bill, we record it by debiting electricity expense $800, increasing that expense, which has the effect of reducing our equity position, and crediting accounts payable, which is a liability account. We increase liabilities with a credit. So the adjustment entry, debit expense, credit accounts payable. This is an example of recording an expense before its payment. The accrual is recorded because it anticipates payments later for the benefit received now in the current month of October. Failure to record this accrual will result in understated expenses and therefore overstated net income and understated liabilities. The lack of payment now is not relevant. The key is that we receive the benefit now, and so now it has to be recorded during the month of October. It's called an accrued expense adjusting journal entry. We get both the balance sheet liability account stated correctly and the income expense account stated correctly in this one adjusting journal entry. Let's demonstrate a prepaid adjustment. An example of a business buying supplies in advance, paying cash for them, and using them later. Our adjustment goal at the end of the period is to record an expense with a debit and reduce the asset with a credit. Let's take a purchase of supplies for $1,500. Let's assume that we paid immediately for these at the beginning of the period, but we'll use those supplies over the next several months. So we've definitely acquired an asset. Those supplies have future value. That's the definition of an asset. So to begin with, our purchase was debited to the supply asset account, increasing it, and we credited cash, decreasing cash. It's just an exchange of assets here. At month end, we have to do an analysis of that supply account. It has a mixed balance. That $1,500, some of it's used, some of it's left on hand. So it's misstated right now. How do we solve that? We take an inventory of the remaining supplies on hand, and we will use that inventory count to correct the mixed balance in the asset account. Presently, it's overstated if some of those supplies have been used. That is, if our ending inventory is not at $1,500. We need to remove the used portion from the asset account and move it into an expense account on the other side of the equation. Again, expense accounts are part of owner's equity. Assets are on the left-hand side of the equation, owner's equity category on the right-hand side. So if we do an analysis at month end and find that there's $800 of supplies remaining on hand, that's the balance we want in the supply account after the adjusting journal entry. The math is very simple. What's the used portion? The difference, $700. So we want to expense, supplies expense, $700 debit, and credit the asset account $700, bringing the asset account down $800 and moving that $700 debit into our measured expenses. It's the adjustment that's the key, not the ending balance of supplies. That will result because of our adjusting journal entry. So we've adjusted your previous payment entry that put $1,500 into our supply asset account. Again, we're getting both the balance sheet asset correct by bringing it down $800 with that $700 entry, and we're stating expense for the period properly as well. Both these examples demonstrated the interrelatedness of the balance sheet and the income statement. The adjusting entry straddled both statements because we know both statements are cut from the same accounting equation cloth. And again, these examples both involve expense recognition. Adjusting entries also involve revenue recognition. Let's take a look at an example. For a revenue example, let's take Time Magazine, which earns regular revenue by delivering publications. But first of all, Time is paid in advance for their services. They collect their subscriptions in advance. So initially, if they collect a one-year subscription costing $60, they would book cash, a debit to cash, increasing that asset by $60. Explaining that increase in assets, they can't call that an earned revenue. They haven't delivered the publications yet, so they must call it an unearned revenue, crediting that, which is a liability account. Debit asset, credit liability, upon receipt of cash initially. At month end, as they've delivered some magazines, they've earned $5 of that revenue, 1/12 of the year. They need to reduce the liability account, debiting unearned revenue and crediting the regular revenue account $5 for that earned revenue. Adjusting journal entry reduces the liability account with a debit and increases the regular revenue account with a credit, effectively shifting that $5 from liabilities to the regular revenue account, which will appear in the income statement. These illustrated adjusting journal entries are not exhaustive. They show the principle of both the balance sheet and the income statement are involved. Both must be adjusted or updated prior to pulling off accurate financial statements. Companies do not adjust or tweak every movement of financial condition daily. Certain events, such as adjusting journal entries, are held until financial statements are required, and they're done in that process of producing the financial statements. It's a final refreshing that occurs before the statements are issued.